$83. That's where silver is trading right now, March 5th. After crashing from $96 to $79 in hours. After bouncing back to $86. After another pullback. The volatility is extreme. But volatility isn't the story. The story is what's happening underneath the price swings that nobody's talking about. COMEX registered inventory sits at 86 million ounces. March delivery contracts demand 52 million ounces. That's 60% of total registered inventory being claimed in a single month. And May contracts are stacking up behind it with 400 million ounces of open interest against that same 86 million ounce pool. The math doesn't work. Hi, I'm Roxanne. No courses, no signals, just the data on what's actually happening and why the next few weeks could determine if silver explodes or collapses. Let's break it down. Before we dig into the COMEX delivery crisis and what it means for price, here's where we stand. Silver spot at $83 as of Wednesday, March 5th. That's down roughly 3% from yesterday's $86 high. MCX India trading around 2.85 lakh per kilogram. Gold holding above $5,100. The gold to silver ratio expanded back to 62 to 1. COMEX registered silver inventory at 86.1 million ounces, down 64% since April 2020. First notice day for March contracts showed 10,526 contracts standing for delivery, representing 52.63 million ounces. That's 60% of registered inventory being demanded in March alone. Let me walk you through what actually happened over the last week, because understanding the pattern matters more than tracking every price tick. Silver hit $96 on Monday, March 2nd, during the initial war premium surge. Within hours, it crashed to $79. That's a $17 drop, roughly 18% decline in a single session. By Wednesday, March 4th, silver had rebounded to $86. A $7 bounce, roughly 9% recovery. Then by today, March 5th, we're back down to $83. 3 days, 3 completely different price levels. This isn't normal volatility. This is forced liquidation mixed with physical buying mixed with algo warfare. What's driving this? On the surface, it's leverage. When CME raised margin requirements from 11% to 15%, then again in some tiers, traders without capital got liquidated. Forced selling pushes price down. Then physical buyers step in at lower levels. They're not trading, they're accumulating. When enough physical demand hits, price bounces. Then another wave of algo selling or profit-taking pushes it back down. But that's just the surface mechanics. The real story is what's happening in COMEX vaults. Because while the paper price whips around between $79 and $96, the physical market is doing something completely different. COMEX registered inventory currently sits at 86.1 million ounces as of early March. To understand why that number is critical, you need to know what registered means. Registered silver is metal that has warrants attached, meaning it's available for delivery against futures contracts. It's the deliverable pool. Eligible silver is metal stored in COMEX vaults that meets quality standards but doesn't have warrants. It can't be delivered unless it's converted to registered. Total COMEX inventory, including both registered and eligible, is around 366 million ounces. But only that 86 million is actually available for delivery right now. Here's the problem. Registered inventory peaked at 240 million ounces in April 2020. It's now at 86 million. That's a 64% decline in less than 6 years. 154 million ounces have left the registered category. Some converted to eligible. Most left the vaults entirely, going to industrial users, ETFs, or private storage. Now look at what's happening in March. First notice day for March contracts was February 27th. On that day, 10,526 contracts stood for delivery. Each contract represents 5,000 ounces. That's 52.63 million ounces being demanded for physical delivery in March, against 86 million ounces of registered inventory. March delivery alone is claiming 60% of total registered inventory. And March isn't finished. We're only in the first week of the delivery period. More contracts could stand for delivery. Historical data shows that major delivery months like March typically see 10 to 20 million ounces delivered. December 2025 set a record with 46.6 million ounces, representing 50% of registered inventory at that time. March 2026 is already exceeding that pace. But March is just the beginning. May is also a major delivery month, and May open interest currently represents approximately 400 million ounces of notional contracts. Now, not all of those will stand for delivery. Historically, maybe 10 to 25% of open interest converts to actual delivery demand during major months. But even if only 10% stands for delivery, that's 40 million ounces. If 25% stands, that's 100 million ounces. After March takes 52 million ounces, how much registered inventory will be left for May? If March drains 60%, that leaves 34 million ounces. May needs somewhere between 40 and 100 million. The math doesn't work unless one of three things happens. Eligible silver gets converted to registered. That requires owners of eligible metal to grant warrants, making it deliverable. That metal was moved to eligible for a reason. The owners didn't want it available for delivery. Will they change their minds now? New metal flows into COMEX vaults. Possible, but registered inventory has been declining for 6 years. What would reverse that trend in the next few weeks? Contracts get cash settled or rolled to later months. This is the most likely outcome. Traders who wanted physical delivery either get it from March, or they're offered cash settlement, or they roll their positions to July or September. But if a significant number refuse cash settlement and demand physical, COMEX faces a delivery default. February wasn't a major delivery month. February typically sees 1 to 5 million ounces delivered. February 2026 delivered 25.18 million ounces. That's 5 to 25 times higher than normal. First notice day for February saw 1,881 contracts delivered, representing 37.3% of the month's total deliveries happening on the first eligible day. Why does February matter? Because February delivery demand happening at elevated levels during a non-major month signals that industrial users and institutional buyers are demanding physical metal immediately rather than rolling positions forward. They're not waiting for lower prices, they're securing supply now. And those deliveries happened during the price crash. Silver was falling from $96 to $79 in late February and early March. Physical buyers were accelerating purchases into the crash. That's the opposite of panic. That's strategic accumulation. While COMEX inventory drains, Shanghai inventory is doing the same thing. Shanghai Gold Exchange silver inventory fell from 559 tons in November 2025 to 318.5 tons in February 2026. That's a 43% decline in 3 months. Combined COMEX and Shanghai drawdown represents about 161 million ounces over recent years. And Shanghai is paying a premium. Throughout the Western price crash, Shanghai spot silver maintained a $9 to $12 premium over COMEX. When COMEX was printing $79, Shanghai was paying $88 to $91 equivalent. Physical buyers in China didn't see $79 as the real price. They saw it as a temporary paper market dislocation. This creates a two-tier market. Paper price in the West, controlled by futures and algo trading. Physical price in the East, determined by actual supply and demand for metal. When the gap gets wide enough, arbitrage forces close it. Metal flows from west to east. COMEX inventory drains further. The cycle accelerates. This isn't the first time COMEX has faced delivery stress. In 1980, the Hunt brothers tried to corner the silver market. COMEX responded by implementing Silver Rule 7, which restricted buying with leverage and forced liquidation. The price crashed from $49 to single digits. In 2011, silver hit $49, before CME raised margin requirements 5 times in 2 weeks. Leveraged longs got liquidated. Price crashed to the mid-20s. In January 2026, silver hit $121, before CME raised margins to 15%. Price crashed 47% to $63 within a week, then recovered to current $83 levels. The pattern is consistent. Exchanges control volatility through margin adjustments, but margin adjustments don't create new physical supply. They force weak hands out and allow strong hands to accumulate lower. But if the strong hands demand physical delivery, margin adjustments don't solve the inventory problem. Let's talk about what actually happens if COMEX registered inventory runs out before all delivery demands are satisfied. COMEX doesn't default in the traditional sense. They don't declare bankruptcy. Instead, they invoke force majeure provisions in contracts that allow cash settlement when physical delivery becomes impossible. But cash settlement at what price? If you're holding a futures contract expecting to receive physical silver at $83, and COMEX says we'll cash settle you instead, what price do they use? The last futures settlement price? The spot price on that day? The Shanghai premium price? This creates legal uncertainty. And legal uncertainty in the world's largest silver exchange would send shockwaves through the entire precious metals market. Traders would question whether COMEX prices reflect real supply and demand, or just paper trading backed by insufficient inventory. Alternative pricing mechanisms would emerge. Shanghai prices could become the new global benchmark. Physical premiums in the West could explode. The gap between paper and physical could widen to $20, $30, even $50 per ounce. Let me give you both sides honestly. The bull case is structural. Sixth consecutive year of supply deficits. Industrial demand at 680 million ounces annually. Mine supply constrained because silver is mostly a byproduct. COMEX inventory drained 64% since 2020. March demands 60% of remaining inventory. Physical buyers paying premiums during paper crashes. If COMEX faces delivery stress, prices could spike violently as paper market credibility collapses. The bear case is technical and macroeconomic. Silver broke below support at $85. Next support is $80, then $75. If the dollar continues strengthening above 100, that creates sustained pressure. If the Federal Reserve signals no rate cuts, opportunity cost of holding silver increases. The gold-to-silver ratio expanding to 62-1 shows silver underperforming, getting treated as a risk asset, not a safe haven. And there's a liquidation risk. If another wave of forced selling hits, silver could test $75 or even the $68 level that CPM Group forecasts. At those levels, mines become unprofitable, supply gets cut. But in the short term, pain is real for anyone over-leveraged. Here are the specific data points that matter over the next 2 weeks. COMEX daily warehouse reports. How much registered inventory is moving? Are eligible to registered conversions happening? Or is registered draining without replacement? March delivery notices. As of March 5th, 52.6 million ounces stood for delivery. How many actually settle with physical metal versus cash? If physical deliveries exceed 45 million ounces, that's 52% of registered inventory gone in 1 month. Shanghai premium. If the premium stays at $9 to $12 during Western volatility, it confirms physical demand is solid. If the premium collapses, it means even Eastern buyers are stepping back. May open interest. Does it grow or shrink? If May open interest stays elevated while March drains inventory, the squeeze intensifies. If May open interest drops as traders roll to later months, the pressure eases. And the dollar. DXY at 99 pushing toward 100. A break above 100 would create multi-week pressure on all dollar-denominated commodities. But if the dollar reverses, precious metals catch a bid. Silver at $83 after crashing from $96 to $79 and bouncing to $86. Extreme volatility driven by margin liquidations and physical buying clashing. But underneath the volatility, COMEX registered inventory at 86 million ounces faces 52 million ounces of March delivery demand. That's 60% of inventory claimed in 1 month. May contracts represent 400 million ounces of open interest. Even 10% delivery demand means 40 million ounces needed. The math doesn't work without eligible conversions, new inflows, or forced cash settlements. February delivered 25 million ounces, 5 to 25 times normal, showing physical buyers accelerating during the crash. Shanghai premium held $9 to $12 through Western volatility. Shanghai inventory down 43% in 3 months. Combined COMEX and Shanghai drain totals 161 million ounces. The bull case says delivery crisis forces paper market reset. The bear case says technical damage and dollar strength push lower first. Watch the daily warehouse reports. Watch March deliveries. Watch May open interest. The next 2 weeks determine if $83 is a floor or a ceiling. Verify everything, stay informed, and I'll see you in the next one.